Hi traders, this is Matt Krupski here at Chartered Financial Services with your weekly options beat coming to you today on a Friday, February the 17th. And today we're doing a little something different. We're looking at something in the news that happened this week in the options. In the S&P options specifically, we saw a fund get into a little bit of trouble with some ratio call spreads. Basically what happens in ratio call spreads, you're buying one call spread down below or at the money, close to where the market is currently trading, and then you're selling call spreads with higher strike to help fund the call that you're buying. And basically by selling, 2 or 3 calls with a smaller premium, that brings enough money to fund the one that you're buying. Problem with that is that opens you to risk on the upside. If the market goes up in a orderly manner, slowly, without a whole lot of gyration, you'll do well. The call that's close to the money will hopefully go into the money, and the calls that you sold above will hopefully expire worthless. So you basically had a free play in that case. In this case, what happened was they had a ratio. I don't know for sure if it was 1/3, 1/4, 1/5, but as their one got in the money, that was great for them. But as we continued to go higher, the calls that were short started to appreciate in value. It does multiple things. First of all, your short calls that are becoming worth more money, that's going to draw down your net asset value, your net liquidation value. That's bad. Secondly, any sort of short options, it's a dynamic margin. So as those short options get closer to in the money or go in the money, your margin requirements increase on that. So you have kind of a double whammy there of your margins increasing, the value of your account is decreasing, you're feeling some pain. So what you do to hedge that as you go higher is to buy futures. If you're short calls and you buy futures and then we continue to go up, you're offsetting the loss on the short calls with your long futures. What that does though is it fuels the buying. So as you're going up, you're buying futures to hedge yourself. The market continues to set new highs, that attracts other buyers. And it kind of builds upon itself. And that's one of the reasons why we've seen us move 80 points in the S&P in basically a week. Where it is, internal risk controls kicked in. They had to exit their position. We've seen the volumes kind of tick up. And so that's one of the reasons why we had such a strong move in the S&P this week. Since that position has reportedly been offset, and we've rallied basically on more of a technical function than any sort of real fundamental news, it wouldn't be a surprise to see a pullback next week in the S&P. That being said, looking at S&P options, there's some really interesting things going on there right now. As we've rallied, the VIX index has actually rallied with it. Typically, when you rally in the S&P, the VIX volatility index comes out. They go in opposite directions. If we fall, the VIX generally goes up. If the market rallies, the VIX generally goes down. In this case, the VIX has actually been rallying on this rally. One way to look at the VIX is that it's a measure of demand for options. If there's low demand for options, the VIX is going to be low because nobody's buying options. VIX is really a reflection of option prices. So a low VIX equates to basically cheap options. If we're rallying and people are buying options, that indicates that, one, they're concerned about the rally. They're generally buying puts to protect themselves. And when we see that happen, it's not frequent that we see the VIX rally along with the S&P. It's frequently a sign of a top. So that's something to look at. Another thing we've seen is just in the past 2 days, there's been an explosion of volume and some really tiny puts for next week. We have the Wednesday week 4 1980 puts. These are 15% out of the money. About 10,000 traded on Wednesday and another almost 4,000 traded yesterday. And they're a nickel each. They're $2.50 real money plus your commissions and fees. But it's a long way out of the money 3 days from now for someone to be buying those. In addition, on Wednesday we saw 17,000 of the week 4 S&P, February S&P 1900 puts. That's over 18% out of the money. And then yesterday, another 10,000. So we're talking nearly 30,000 options for next week. Total 40,000 options. You're looking at 15 to 20% out of the money in 1 week's time. Just interesting. Most likely, we're not talking about a lot of money here. It's $100,000 total. Plus your commission and fees, roughly. But for something to be that far out of the money and to see that kind of explosion volume, it's interesting to me, something to keep an eye on. One explanation, it could be a hedge. If somebody has a position such as a credit default swap on a highly correlated S&P name, they could be coming in to hedge the market, just to hedge that position by buying tiny puts on the index in case their position starts to go against them. They figure that the S&P will go lower as well. So it could just be a hedge for another position that we don't know about. It's just something interesting to look at. And then the other thing, like I said, this VIX and S&P moving the same direction, something to keep an eye on. It's actually done it the most number of days this year since 1995. So we're kind of seeing some record moves there. Something to keep an eye on going into the next couple weeks here. I think we're going to maybe see some more volatility in the S&P, but that's what we've got today. And just a reminder, these are my thoughts, not those of ADM or ADM Investor Services or Archer Financial Services. And this stuff is just interesting to me. I thought I'd bring it to you. If you want to talk about it, feel free to send me an email or give me a buzz. I'm happy to discuss it with you. Thanks a lot. Have a great day.